What's up, everybody? Salute. Welcome to TGO. This video is going to be a mentorship video. If you're watching this outside of the mentorship, you're going to get the basic beginning training. For those of y'all who are members, you're going to get a little bit more added to this video. So it depends on when you're watching. If you like what you hear, I would consider becoming a member and joining the trading chair, mentorship, and checking out all the videos, because these videos are going to help you. So let's start off with a naked chart. And let's make it a default chart, and we're gonna get started. Okay, so let's zoom out because I like to zoom out. Okay, so here's what we're gonna do. The first thing we're gonna do is we're gonna identify with the way that this pair is moving. So let's lock the pair in, and we're gonna see that we're clearly in the downtrend right here, and we are on a 1 hour. Okay, so what we're gonna do is we're gonna use one indicator, and this is my secret move. Now, this is part of a move that I do, that I use. Now, the reason I can't post the entire move here is because when you post something on the internet, a lot of people tend to run with it, becomes popular, and then it becomes what people target for liquidity. Now, I've heard a lot of people say that the ultimate move that I like to use, the one that's reliable for me, doesn't work. And I've used it time and time again to be very successful. And over the last 2 years, I had to get well over 200,000 pips using this, documented on YouTube. Okay, so I'm going to show you part of it, and this is the most important move, and I'm going to give it to you for free. So tune in and let's get to it. So the first thing I'm going to do is go to the charts, right? Go to indicators, and we're going to want to add, and if you can't see this, it's because I'm using OBS Studio, and for some reason OBS Studio blocks certain things. So I like using this because it's easier to record with, but unfortunately, you probably can't see. So what I'm doing is I went to the insert tab at the top. I went to indicators. Then I went down to trends. And I'm going to go down to about towards the middle. It says moving averages. And I'm going to click that. What I'm going to put on the chart is the 200 moving average. Now, just for you to know the difference, I am going to make the method at the bottom exponential. And I'm going to apply the close. And I'm going to make it yellow. Okay. So boom. This is the 200 moving average. Now, a lot of y'all gonna go, oh, it's a moving average. Everyone uses moving averages. Well, what you don't know about moving averages is that they're a period of data from the past that is used to determine price in the future. So what does this mean? This means that based off the previous price action that we've seen in the last 200 days, right? This is going to determine what they think the trend is going to be, and the moving average is going to be there showing you what price was like or where it was predicted to head based off that data. So moving averages are actually very powerful. They're not they're considered repainting, so people consider them not usable, but that's okay because most of those people just don't know how to use it. So I'm going to show you right now. We're going to go over different charts. I'm going to show you everything. Okay, so we applied it to the chart, and as you can see, price broke right here, right? This big red candle. We see that price clearly broke below the 200. Now, what happened when this happened? What occurred when price broke below the 200? Okay, what happened? It clearly went into a downtrend. So you're gonna always want to use the 200 moving average on a higher time frame, like the 1 hour or even the 4 hour. You get a much clearer picture on the 4 hour. And you're going to want to use it on, you can use it on a lower time frame, but it's just not as practical, okay, as you see, because this is what people don't get about time frames. When you're on a lower time frame, you're going to get a smaller move. So it is okay to trade a lower time frames, because a lot of swing traders don't like lower time frames, and a lot of scalpers don't like higher time frames. It's just the law of nature. It's okay. Left hand, right hand is cool. We don't got to debate. We don't got to beef. We don't got to gang bang over it. It's cool. If you don't like it, it's fine. But I'm going to show you how to use it for both, because I do everything. I prefer to swing trade. I do not scalp. I hardly scalp. I recently started scalping just to make sure that I can. So let's get into it. So if we pay attention to the chart, if we zoom out, let's unlock the chart. Okay, if you look all the way back, right, you can see that a lot of times this 200 was acting as a support or a resistance, right? So let's go to the end of the chart, and let's just look at it real fast, okay? Let's lock the chart right here. As you see, when price breaks above the 200, it's usually a sign of a very strong trend direction. Now, like I said, depending on the time frame you're on, it's gonna give you that move. Now, on this 1 minute chart, if we're paying attention, right, on this 1 minute chart, this move went to, this move did 14 pips. Now that doesn't seem like a lot, but for scalpers, 14 pips is good. Most scalpers I know try to get 10 pips or more. So that's fairly reasonable. I mean, for me, that's not, my stop loss is bigger than 10 pips. But as you go to a higher time frame, what you're gonna notice is the move becomes a lot bigger. So you see how we had this big buy candle. Let's go to a higher time frame and look at how that looks. You see how that looks a little bit different? Let's zoom in on the chart. You see it looks a little bit different. Now if we go to a higher time frame, all those candles become one as you go to the 30 minute, which is where I would say I would start using the 200 for a big move, a move over 20 pips. It depends on the time frame. So we're gonna see that every time price got to this 200, there was some kind of reaction. Okay, so let's start at the beginning. Let's pick a spot. Right here, you see price broke below, right, and it kept going down, but it wasn't ready to go all the way down, and it just ranged. So we consider this a ranging market. So what we're gonna do is we're gonna put a object here. Let's use a shape, and we're gonna show you this is a range, because let's use this point as the range. This is clearly the range. Okay, so this was a range, and you need, when you see these ranges happen, I'm gonna give you all the information y'all need in this one video. Let me fix this up. Let's make this let's make it okay, I'm trying to make this where it's not I want this to look full. I want it to look full. I don't want it to look the way it's looking. I don't know how to do that on MT5, unfortunately, but there is a way to do it. I just don't remember how. Oh well, I guess I'll have to figure that off camera. Oh yeah, there we go. I see it. Boom. Boom. There we go. Sorry guys. Okay, so what you need to do in this situation is you have to disregard the 200 once you see this happening. And there is a way to check this, and I'm going to explain it on the mentorship side of the video. But for now, let's just explain what I would do if I was in this situation. Okay, once you determine that you have a range, and clearly the reason I disregarded this wick sticking out like this is because the market was ranging. So anybody that was buying and selling, what this was doing was this was faking you out. So if you were trying to trade this, this was going to liquidity grab and just keep taking money. The market does that. And when it does that, it's best to just not trade it, or trade it with very good stop losses and TPs. But if you go to a higher time frame, this is not that bad of a move. But think about it. Every candle is an hour in this box, right? So if every candle is an hour in this box, this is terrible, because that means that for the whole day, this market was just ranging like this, and you would have to literally keep scalping and trading the range. This becomes a little bit more tradable when you go to a lower time frame. So that's why it's good to be a scalper in these situations, because in these situations, look, this box was, you can't even see the box anymore. You see, because there's so many minutes and so many candles inside the box. But then when we go to the 15, you see this box, you see. So people who trade the 15 are fine with this. And why is that? Because this is like what the whole chart looks like on a 15-minute, right? So let's just use the pip tool, right, and see. So from this ranging point, let's just see right here, right? When we went into this range, the market was giving you I hate that it's in points now. It was in pips before, but now it's in points. I hate that, because then you gotta know your math to do that. Yeah, so this was 50 pips, 54 pips. Okay, so and just to let y'all know, if you want to ever know how to tell the difference between points and pips, I'm giving you the source in this video. Just take the last digit off the back, and that would be your pip count. Okay, you add a digit for a point. Just to let y'all know the difference, because a lot of y'all don't know that and y'all ask that, and no one tells y'all because they don't know. So I'm gonna explain that to y'all because I make software so I know. Anyway, so as you can see, the 200 was not even worth checking out at this point. There is a way to tell if this is gonna happen on the pair that you're trading. Like I said, I'm gonna teach that in a minute to the mentors. But for the people that came here for the free source, I got y'all. So you would just kind of just leave this, man. I would leave this alone because that's why I like the 1 hour, and you get to see clear as day that this is just not worth bothering with. And when I see this type of stuff going on, I just leave my robot on alert mode, and I'll let it tell me when price is getting into a trend, and then I'll put on a scan and see if the trend is strong. And then whenever the trend breaks into a breakout, I enter the trade. That's my strategy, right? So you ain't coming for that. So as you can see, this range was going on for a little while. This is some nasty work occurring here. So what you would want to do is you would want to just take the amount of pips that you see this breaking out of the 200 with. And what do I mean by that? I'll explain it. Once again, every time it broke our highest point was 50 pips. Remember, we got 50 pips again, right? So that 50 pips came up on the lower time frame and the higher time frame. Now we're going to notice that when it breaks, it's probably going to be favoring doing this. 70 at the lowest point. Let's go to the lowest point. At the lowest point, if you stayed in this trade when it break to 200, you would have got 85 pips. Not bad, right? Not bad. So we're not gonna go up and down. We're just gonna go every time it broke to 200, just to show you that when it breaks to 200, it's a trend move, and you want to use this if you're a beginning trader. If you're an advanced trader, you'll know how to use a little bit more than this. But once again, it broke 20 pips, then it broke down again. See, this is a fake out because this is what you call liquidity grabs. It broke to 200, then it came right back through it because they know people are going to trade the 200. That's why I use more than just the 200 to enter the trade, but you can use the 200 to tell price is trying to uptrend or downtrend. Even though it broke, because it broke the 200 and went up, even though it came down and closed, this is what you call a liquidity grab because people are going to sell here and it's going to still continue to go up. How would you know the difference? There is a way to tell. Once again, I'll tell you at the back of this video. There's a way to tell when that's happening. There is a solid way to tell, but I don't want to put it here because then they'll know that we know and they'll know how to stop it. So, but once again, let's stick to the topic. Every time it breaks, like I said, you're averaging about 50 pips. This is 60 pips again. You're averaging about 50 pips. So we know now, right? Just based off what I said in this video, and look at this breakout. This is why I love the 1 hour. This is the real breakout. It broke the 200, and once it created this high right here, let me mark it. I'm gonna teach y'all the source today. I'm gonna show you how you knew this was a strong breakout. I'm gonna show you. Some of y'all, if y'all know, please put it in the comments right now. As I'm talking, put it in the comments if you're watching this and you know what it is, because I'm gonna teach y'all. Y'all gonna learn today, man. What am I looking for? I'm looking for shapes and objects. That's what I'm looking for. Shapes, rectangle. Okay, this is the thing that you want to see. See this area right here? This was the high, right? This was the high. Once this got broken, this next candle right here, I'm gonna mark it again. I'm gonna show you which candle I'm talking about so y'all know. Objects, shapes, triangles. This candle break. Once this candle closed, this was your confirmation that this was gonna be a super breakout. Okay, and of course you don't have to wait for that. What you need to do is what I just said. When price breaks to 200, we know that we're looking for 50 pips, right? So let's look at how would you place your stop loss. If every time it breaks like this, it's giving you an average of 50 pips, which we've seen 3 times already. So we know that on this pair, NZD USD, because every pair is different, you got to stick to that pair and master that pair. We have learned in this video that NZD USD likes to break 200 for 50 pips. Okay, so what do you do to protect yourself if you want to take this trade and you don't want to have too much risk involved? Well, we know we're going for 50 pips. So what will we do? We will look at every time it faked us out. So every time it broke, right, it pulled back. It pulled back 20 pips. Keep in mind, I'm going to tell y'all a secret in this video. Just keep in mind, I said it pulled back 20 pips. You're going to see anywhere between 20 to 30 pips a lot. I'm going to tell y'all that secret, and I'm going to tell you why. See, it pulled back when it broke. It broke. It went down here, 18 pips. Notice it's around 20 pips, right? Just keep that number in mind. It broke. It faked everyone out. 11 pips. Why is it always this number? I'm going to tell you why. It broke above. Everyone thought it was buying. It was a fake out. 15 pips. So what we have learned is that if you want to take this trade off the 200 on NZD/USD, I'm giving y'all the source here, you will want to always use a 20 pip stop loss on a 1 hour chart. Why did I say that? Because we seen that the liquidity grabs are 20 pips, guys. I'm giving y'all the secrets. Please pay attention, ladies and gentlemen. I just gave y'all the source on this pair. Every time they do liquidity grabs, they are using 20 pips to trap traders. So if you always want to do a risk, well, we're risking is a 1 to 2.5. We see that every time the 200 is broken, it gives us a 50 pip move. If it's a fake out, it's giving us a 20 pip loss. So every time we cross the 200 and we take the trade, we're going to take the trade for 50 pips with a 20 pip stop loss. It rarely ever went past 20 pips. If it's passing 20 pips, we know that that's just the trend direction is going in. And now after 20 pips, you may want to consider entering that direction for the other 30 pips before it goes back to test the 200. So this is why you have to follow price. All the strategies that people use is nice, even as 200. You see, I'm showing you there's liquidity grabs even on that because the market knows about all the strategies we use, and they will go after those people if they enter. Because a lot of people know the 200 moving average is the most respected moving average. So what happens is a lot of people are going to trade it. So what they're going to do on the days when the market has to make its money is they're going to liquidity grab people. So if you're smart and you do what I just did, which is put your stop loss in that direction, yes, you're going to lose. But if you take 10 trades based off what we just saw with a 20 pip stop loss and a 50 pip take profit, you would only be losing maybe 3 out of 10. So your win rate should be about 7 out of 10 trades winning and 3 out of 10 losing. And you're risking 1 to 2. So every time that you win, it's 1 to every time you win, it's 50 pips. Every time you lose, it's 20. So you're losing 60 pips. Now 7 times 5 is what? Do the math. Let's do it real quick. 7 times 5 is 300. So you should be getting 300 pips for every 60 pips you're losing when you take a trade on a 1 hour based off the 200 moving average. Does this make any sense to y'all? Now the problem is once people figure this out, and a lot of people start doing this, the market will adjust to the situation. So you have to always watch your charts and understand this math that I just gave you and just keep it and tweak it. If you see the market is starting to go 30 pips, you have to adjust the stop loss. Okay? So you can always stay ahead of the liquidity grabs because you're going to lose here and there. It's going to happen. Anybody who tells you that they don't get caught at any time, no, the market is manipulated and they're going to do this to you. So I'm telling you how to calculate this, okay? So that you understand how to not get caught in the liquidity grabs as you trade the 200 because once again, this is the most respected moving average. Most people say moving averages don't work. Just every trader you see uses it. Any trader I know with 10 years or better uses moving averages as their main indicator. And I'm telling you now, don't listen to that. As you can see, I just showed y'all how to trade it successfully right here. So hopefully y'all understand that, okay? Now, keep in mind, if you're a beginner trader, I'm going to warn you right now, if you made it to this portion of the video, this move takes a lot of time to do. This is not going to happen more than once or twice a day. If you're lucky, it's going to happen once every day or twice a day. You'll see it sometimes, but it doesn't happen all the time. The 200 moving average is so powerful that when the price is breaking, you have to be there or have some kind of system like me to understand it because it's such a powerful move. It happens maybe 3 times in a week sometimes. If you're lucky, you'll see it 5 times in a week. But like I said, if we put the period separator on this chart, we'll see how many days this happened, okay? On this pair, it happened 1, 2, 3, 4, and then it didn't happen again. Look, 1, 2, 3. We had to wait 3 days. Then it happened again the next day. Then we had to wait 1, 2, 3. So we now know more data that NZD/USD, the 200 period moving average likes to get tested every 3 days. Okay, so you have to be patient because once you're in that trade, you can swing trade that for those couple days, or you could get what you need to get. But this setup doesn't happen frequent. That's why when it happens, it's okay to take this trade a little bit better because the market is kind of having to do this to get other traders and trap them. So you can just follow the price through this trend, okay? And you'll be a little bit safer because this takes so long to happen. Most traders want to get in there and trade for 15 minutes and get out. You'll never see this move. You'll see it happen. You'll miss it. You have to be, up and ready to take this trade when it occurs. That's why I like indicators and EAs, because it's gonna tell me. I can get an alert right to my phone. My robot will tell me, hey, price just crossed the 200 on the pair, and I'll look and I'll say, all right, 20 pip stop loss, 50 pip take profit. Once I see I'm in profit 50 pips, I'll take my take profit and move it, and then we'll trail and stop the trade until it knocks me out. Because as you can see, if you look at the chart right here, when this broke, we would have entered here, and at 50 pips, look what we would have got. Had we trailed the trade, we would have got 90 pips. So why would I give away the other 40 when I know I'm already in the right trend direction? You understand? So that's swing trader talk right there. But hopefully this video was helpful, and this is a start to help y'all. Like I said, if you want more in-depth knowledge like this, you have to subscribe to my mentorship or join the Discord. I have private training in there. Check it out. Go to the website and check out the private training tab if you want to get a one-on-one or anything like that. This video is a video you're going to have to watch over and over. And you're going to have to look at your favorite pair, pick a pair, put this 200 on, and look at it every day. Don't trade it. Just look at it every day, and you'll see what I'm saying, and you'll be like, yo, it's going to click. And once it starts clicking and you start trading, you'll start catching those big trades, those big breakouts that y'all see me take. I'm giving this to y'all for free. This is how you catch those big 100 pip moves, and you can do it constantly as long as you just follow what I just taught you. Now, for those of you who are mentors, mentees, I hate to use those terms, but I'm going to break this down for you now, how you can further chase this. Okay, so let's get into this portion of the video. So I hope y'all enjoyed the video. Do remember that if you log on to TradeGameOfficial.com, there is the private training tab where I have the one-on-ones, the private training classes, and we have the bank series training where I teach y'all how to use the moving averages the way that I use them to chase price. This is something that I do privately. I don't do it publicly. So if you're interested, go to the website and check it out, and message me in Discord. You can contact me on Telegram, or you can email me. Enjoy. I'm out of here. Peace and happy trading.